Hi there. For high growth companies, forecasting can often result in a rather happy dilemma. For example, if they purchase lots of stock, they can capitalize on those large spikes in demand. However, unfortunately, this growth can't last forever, and this strategy can result in wasted stock, such as the $4.3 billion worth that H&M reported early this year. So Johannes, in terms of forecasting high growth scenarios, it's a fairly difficult on the face of things. So what are the sort of problems that companies kind of face here?
So there are actually a series of problems. I mean, first is probably that when companies are growing internally, there is a large amount of disorganization that is just a result of the growth itself. So that complicates everything, forecasting being one of the things that is also being made more complicated by the growth. But then on a statistical basis, it really depends exactly what is generating the growth. And there is many different ways of growing that can actually make the forecast more or less, I would say, extra complicated to accommodate for the growth.
So what sort of ways of growing are we sort of talking about here?
So, I mean, there is probably the easiest sort of growth is the very organic growth where, let's say, every month, let's say you're an e-commerce, every month your website gets a bit more traffic and all your products are going upward, I would say, just linearly correlated with the growth of the traffic of your website. So that is, I would say, the easy situation. Because it's pretty much uniform, it's not too heterogeneous. There is a question on whether this growth will continue forever, just like the case of H&M, that can hurt pretty bad if you anticipate a big growth, I would say, company-wide that don't materialize. But still, from a pure forecasting perspective, it's, I would say, the easy situation. Another way of growing is when you push new products. So that means that there are things that you sell that may or may not be growing, and then you get better at introducing new products to the market, and those products may be hit or miss. So that means that your growth is driven by new products, but not all of them, some of them. So that's typically when companies get better at optimizing their assortment and identifying the things that are going to be the most attractive to the market. So that can happen, for example, for fashion companies that gets better and better at pushing products that becomes massive hit once in a while. So that is much more difficult in terms of statistical forecasts because most of your products are not especially growing, so you have very flattish demand forecast. And then for the new products that you're still launching, most of them are not necessarily that much, I would say, bigger in terms of sales than they used to be in the past. It's just that sometimes you have, I would say, massive hits that are much more massive than what they used to be in the past. But the problem is that if it's only one product out of 20 that is a massive hit, you cannot decide to double the amount of inventory that you put on every single product, because for most products, you do not have, I would say, sales that are vastly larger than what you used before.
So in this sort of scenario, kind of the hit or miss scenario, you've got one product out of 20 that's actually really successful. How do you react to that? How do you respond? Is it something that you can sort of put extra stock in all of the items in your catalog, but that's kind of wasting money, right?
Yes, exactly. So it doesn't work. It cannot be an undifferentiated answer. And also, it means that you will end up in your forecast with a lot of, I would say, very puzzling biases, such as your business is growing, but if you look at the forecast and the projected sales, it's not growing. I would say when you look at the projected sales at a very disaggregated level, typically for two reasons. First, because you don't know which product is going to explode, so the average is much lower than what you will actually get, because you will have sometimes a product that explode, but also the fact that you don't exactly know how many products you're going to launch in the future. So that all those products that you do not have yet in your pipeline that are ready to be forecasted, I would say demand-wise, because you have all the attributes, all the characteristics and whatnot, are basically absent from your forecast, so that you forecast basically the demand that you see for the products that you have, the products that you've already planned to launch, but the products that are, I would say, that are still projects to be even considered for a launch, they are not part, I would say, of the statistical forecast.
Okay, so other than sort of not knowing which of your products are going to really grow, are there any other sort of problems that we face when forecasting growth?
Yes, there is also the fact that I just discussed from the case where the growth of the business itself was relatively organic, and and it repeats itself month to month. But what happens for many businesses that can be online or even traditional brick and mortar is that growth is, I would say, a stepwise function where you are growing, I would say, very slowly, and then there is a step that you take, and then you have from 1 month to the next you get a 10% growth, and then no growth whatsoever for a couple of months afterwards. So why does those sort of steps happen? Online, for e-commerce, you can have dramatic impacts from the search engine result pages. So basically, if Google ranks you better, or on the contrary, if Google de-rank you, then you can have, relatively dramatic effect where overnight your business double in size or is divided into overnight as well. You can have effects with that did happen in the past a lot for e-commerce, where it was like the first time in a country where someone in a given market was starting to do national TV ads. So let's say, for example, you want to buy car parts. People were not used to buy car parts online, and then at some point there is a player that in this market that decide to have to a massive TV campaign, and then people realize that they can buy car parts online, and they start doing that. And even for the players that were not doing the TV, that were not actually paying for the TV ads, they were still benefiting from the overall uplift of the market, because people were actually trying to compare the prices and see what's out there, just because they had realized that this sort of product could be bought online.
So what you're sort of saying there is the key problem is a company might know that they're going to grow, they're going to make that extra step at some point, but the real problem is they don't know when that's going to happen.
Yes, I mean, they know that it has a chance to happen, but they might not know exactly when. And then indeed, to a large extent, for example, I mean, there are cases where you have a good guess where you might actually I would say ramp up. That might be, for example, if you open a new country. So, for example, if you were selling in a couple of countries in Europe and you decide to extend to one more country, then you know that the day you start to open this country, you can expect a step because you trigger a new country. Although still you are entering the realm of the situation that are not exactly eligible for actual statistical forecasts, because you do not have, I would say, a statistically significant set of events that represent opening in new countries. There is only like 30 countries in Europe, so it's an exercise that you can only do a dozen of times or so. I mean, especially considering that some countries are much larger than others.
Okay, so it sounds like it's pretty messy. You only know that maybe 1 out of 20 of your products is going to do a real succeed, but you don't know which one, and also you don't know when that's going to happen. So what's the solution here? Can we actually forecast these scenarios?
So the trick is that typically it's very hard to get a better forecast on, I would say, the average outcome. The average outcome is going to be extremely fuzzy. And because, for example, when you have hit or miss patterns, it means that you do not know the hits, unfortunately. If you do, you would probably be incredibly rich because you would be able to do hit after hit. If, it's exceedingly difficult. But you can know the statistical structure of your growth. So that, for example, you can differentiate between a business where the growth is driven by hit or miss at the product level, or by sort of step growth at the company-wide level, or if it's another kind of growth that is even completely different, such as some products gradually grow over time to become very, very large, and it's not all products but only certain. So by capturing, I would say, the nature, the statistical nature of the risk, you can take better inventory decisions. For example, you can, if you have hit or miss, and you know that you have this sort of structure that drives your growth, what you want is probably to have an inventory policy that is very conservative at the beginning, but that is incredibly reactive and aggressive when you start to detect that a product appears to be a hit in development. So you want to have something that is developing, that is very, very reactive, and you know that it's the right I would say strategy in terms of inventory risk versus expected reward at properly capturing a hit, because your business, in your business, such hits are happening, I would say, frequently. In a business where you do not have those patterns of hit or miss, where products can grow, but they will grow, I would say, organically over extended period of time, you know that, for example, if you see a product that start to grow very fast, it's probably not, I would say, a hit, it's probably just a fluke. And so it would be a bad inventory decision to just super aggressively respond to the growth.
Okay, so what we're sort of saying here is you can produce some sort of forecast, but it's going to be very blurred. So how do we sort of mitigate for that blurriness? Because in sort of a hit or miss kind of scenario, it sounds like that blurriness is going to be quite big, no?
Absolutely. I mean, there are a few businesses where you can more predictably predict the future. For example, let's say in aerospace, if you're servicing parts for aircraft, the growth that you will see in your supply chain is typically related to the number of aircraft that you need to serve. And because all your business is dependent on on long-term contracts that can last years, you typically know month in advance that you will have 20 more aircraft to serve for your supply chain. So that's a situation where you have a co-variable, so something that explains the underlying demand, that is known well ahead of time compared to the actual demand. But for most businesses, you do not have the luxury of having such an indicator that ahead of time let you anticipate your supply chain growth instead of having your sales growth. So what you can do is typically adjust other variables, such as, for example, you can try to negotiate better MOQs with your suppliers, possibly by spending more money, I would say, per unit. So, for example, that's something that can be very useful for to accommodate the hit or miss situation. That means that you can buy smaller quantities, test the water, and then respond aggressively if you think that it's a hit, instead of having like an MOQ where everywhere you are purchasing, I would say, a sizable portion of inventory, and you end up with overstocks on all your miss.
Okay, so we sort of spoke a bit earlier about those sort of steps and making the jump to that,
Yes.
to that step. What sort of clues are there out there for a company that they're about to enter this sort of growth period? What should they be looking out for?
The problem is that typically if there was stuff that you could really leverage statistically, I mean, at Lokad, we would not be doing supply chain, we're just playing the stock market. The trick is that there is no trick. I mean, usually it's fundamentally irreducible uncertainty. If you had a way to be absolutely sure that you are going to grow, basically some company would be exploiting this very trick, to grow indefinitely. And just as H&M did prove, even the very best, they are growing for a very, very long period of time until they become exceedingly large companies. But at some point, there is limits to the market, and and basically this growth just stopped ticking.
So things like the Google sort of search statistics, is that not something we could include into forecasts? Would that not give us a bit of insight here?
Yeah, I mean, yes or no, because typically the problem is that, let's say, for example, you are selling a product like a light drug against if you've just caught a cold. The problem is that you need to source that weeks in advance, if not months. And yes, Google search will tell you with maybe a few hours a head start when people start to type that online, say, oh, I have a cold, what can I get to sleep better? But they will only start to type that at the last moment. So maybe to basically have a better forecast with a few hours of head start for the next day, maybe. But the point is that in supply chain, you need to be able to look typically at least a few weeks ahead. So the search results, even if you have them real time, that doesn't help you to anticipate things that are going to happen in a couple of weeks.
Okay, so if I'm in that sort of happy scenario and that I'm seeing my company grow exponentially, what can I do to be sort of best prepared? You sort of mentioned there, improve the relationships with your supplier, maybe change those sort of minimum order quantities. What else can I do to be as prepared as possible?
So typically the thing that is maybe counterintuitive is to anticipate the fact that your IT landscape is going to be in complete flux for a long period of time, which typically, I would say, complicates everything, because that means that accessing the data is going to be even more complicated than it usually is. And what happens is that companies that grow, typically every 2 or 3 years, let's say they are growing like 50% a year or so, every time they grow of a factor, let's say 3 to 5, they need to change everything in their IT. The ERP is not good enough, the website is not good enough, the WMS is not good enough, etc., etc., etc. So that the entire applicative landscape it has to be replaced. And the problem is that if you do that, I would say every 2 or 3 years, then there is the danger of not being able to reconciliate your history with the data that you get from the new system. You end up with, you fire a new ERP or new WMS, and then you have to reconciliate the data that you had from the old system with the data that you have from the new system, and you can have tons of inconsistencies, and that makes, forecasting under growth even more complicated than it should be, just because you have all those IT accidents that happen all the time.
Okay, and now let's just sort of talk about what happens kind of in the real world. Would you say that often people are over forecasting how much they're going to grow because there's a sort of emotional attachment to their sort of companies?
Yes, I mean, not necessarily. Obviously, there is this tendency to be overly optimistic. So normally the idea is to hope for the best but prepare for the worst. And typically, or at least frequently, people do the exact opposite. But fundamentally, what happens is that very few companies try to model their risk, I would say, quantitatively. And that's what we try to do at Lokad with this idea of quantitative supply chain, is that growth is a certain class of risk. It means that there is a certain class of uncertainty where your business can, or some products can suddenly sell a lot more. And you need to have processes in place where you can react very, very swiftly to this sort of situation. And very swiftly typically mean by not having people in the loop. Because if you expect that coping with the growth depends on supply chain managers that need to look at the data on a daily basis, make their mind to the fact that what they're saying is not noise, but really the result that this product has entered a new stage of sales volume where it compared to the previous stage, it's now selling 20% more or whatever. And people will want to wait a bit to be confident in what they see. I mean, you can easily add a couple of weeks of lag just because you have, I would say, humans in the loop to implement decisions. So probably one way of coping with growth is not necessarily to be that much better in anticipating the growth, is just that when the growth is statistically noticeable, to act on it much faster, which means to have like end-to-end automated decision mechanism that basically trigger reorder faster, as opposed to have someone that is going to wait until you're unfortunately very confident in what you're saying, but that also means typically that you're very confident in facing stockouts, because you see, if you wait that you're very confident that the product is a hit, typically you're nearly guaranteed to have waited so long that you're near guaranteed to have a stock out, because you've not passed a reorder early enough to accommodate for this emergent hit.
Okay, so to sort of wrap things up, kind of the core message to take away from today is basically, if you're a business and you're experiencing huge amounts of growth, it's better to be way more reflexive and responsive rather than it is to sort of store up stock and act in kind of with the future in mind. Would you sort of agree with that?
Yes, and to really think of the fine structure of your growth and to differentiate that, so that you can deal with the growth very differently, whether it's like business-wise, organic, steady growth, or hit or miss, or any kind of other alternative growth structure, such as opening countries or something like that, because the consequence for your supply chain and for the way you size your inventory are very, very different.
Okay, great. Well, we're going to have to wrap things up there, but thanks for your time. So that's everything for this week. We'll be back next week with another episode, but until then, thanks for watching.